right now, I mean, if you ask around, pretty much everyone thinks this whole AI gold rush is happening entirely in the cloud.
Oh, absolutely. 100%.
Right. Like if you talk to almost any retail investor, or honestly, even some of the big institutional guys, the conventional wisdom is just that physical hardware is dead. Done.
Yeah, that it's a dinosaur.
Exactly. Everything is virtual. Everything is just happening in some, invisible hyperscale server farm owned by one of the three massive tech giants.
Right, out in a desert somewhere.
Right. But what if I told you that one of the most profitable, most critical AI companies in the world right now is actually making its fortune selling physical heavy metal boxes to sit in corporate basements?
It just completely shatters the narrative, doesn't it? I mean, we've been fed this story for the last 10 years.
We really have.
We've been conditioned to believe that on-premise hardware is just this shrinking relic of the .com era. But when you actually look at the underlying infrastructure, like what is physically required to make artificial intelligence function at scale, the physical reality is reasserting itself.
The heavy metal is back.
The hardware is back.
Yeah.
And it is honestly more important than ever.
Well, welcome to a special Talk Tickers edition of the Deep Dive. Our mission today is straightforward, but it's incredibly vital for your portfolio. We're looking directly at the number.
The real numbers.
Right, the raw data. We are taking the F5 Inc. Q3 2026 earnings call transcript, so that is ticker symbol FFIV, and we're going to extract concise data forward and really actionable analysis for you, the retail investor.
And no Wall Street jargon.
Exactly. We are stripping all of that away. We're going to explain how this technology actually works mechanically and figure out if this stock is a buy, a hold, or a sell.
And, F5 is just the perfect company to put under the microscope right now.
Why is that?
Because their Q3 transcript paints this picture of a business that's quietly cashing in on the AI boom, but they're doing it in this very specific, almost hidden way. Like they're generating massive amounts of cash, but they aren't the ones making the flashy front page headlines.
Right. Because if you think about it, the internet right now is throwing the biggest, most chaotic, most expensive AI party in human history, right? Everyone's rushing the doors, data is flowing like a tidal wave, applications are getting impossibly complex.
Yeah, it's a madhouse.
But F5 isn't the one hosting the party. They aren't building the foundational AI models like OpenAI or Google. They aren't the DJ.
No, they're the bouncer.
They are the bouncer. They're the traffic cops outside the venue. They sit right at the front door of the world's most critical corporate networks, and they make sure the right data gets in, the bad actors stay out, and the whole system doesn't just collapse under its own weight.
It's a really highly accurate way to visualize their business model. At their core, they are an application delivery and security company.
Right.
And what we're seeing in this Q3 transcript is that the need for a highly competent, heavily armed bouncer has just never been higher.
Because the threats are getting worse.
The threat landscape has expanded exponentially. And on top of that, the sheer volume of traffic generated by AI has escalated dramatically. But, to really understand if being the bouncer at the AI party is actually a profitable business for your portfolio, we have to start with the raw data.
Exactly. Let's get into the headline numbers from Q3. So F5 reported that total revenue grew 11% year over year.
Which is solid.
Solid, yeah. But the number that really jumps off the page is product revenue. Product revenue hit $463 million. That is a jump of 19% year over year.
Wow.
And here's where it gets really interesting for anyone tracking the stock long term. That marks 8 consecutive quarters of double-digit product growth.
8 quarters. That's 2 full years.
2 full years of double-digit growth. And finally, non-GAAP earnings per share, or EPS, grew 14%.
I mean, those are undeniably strong top-line numbers, particularly that 19% growth in product revenue.
Yeah, for a legacy company, that's huge.
Exactly. When a mature company, and remember, F5 has been around for 3 decades.
Right.
When they start stringing together 8 quarters of double-digit product growth, it tells you that something fundamental has shifted in their market.
Right. It's not a fluke anymore.
No, it's a trend. But to contextualize this for you as an investor, we need to look below the top line, because it's one thing to sell a lot of product right.
Sure.
It's entirely another thing to do it profitably. What really stands out to me in this transcript is the extreme financial discipline F5's management team demonstrated.
You're talking about the margins.
Let's talk about their margins. Their non-GAAP gross margins came in at a massive 84.2%.
Okay, let's pause on that. because I want to make sure the gravity of that number actually lands. 84.2%.
It's huge.
That means for every single dollar they make selling a product, it only costs them about 16 cents to actually build, manufacture, or deliver the thing. That is software company level margin. But they're selling hardware. How is it physically possible to achieve an 84% gross margin when you are manufacturing heavy metal boxes filled with silicon and copper?
It's a brilliant question, and it really gets to the heart of why F5 is so misunderstood by casual investors.
Okay, explain it to me.
So, yes, they sell physical hardware appliances, but the hardware itself is essentially just a highly commoditized delivery mechanism.
Okay.
What the customer is actually paying a premium for is the incredibly proprietary, deeply complex software running inside that box. F5's operating system, their traffic management software, their security algorithms, that is the actual intellectual property.
So they package it inside a physical box because the customer needs the physical processing power.
Exactly. The customer needs the hardware to handle the massive data throughput, but the margin profile reflects the software business. The 16 cents covers the metal and the memory chips. The 84 cents is the value of the code.
Okay, that makes perfect sense. So the box is basically just the Trojan horse for the high margin software.
Exactly right.
And we also need to clarify something for the retail investor listening right now. What exactly does non-GAAP mean when we say non-GAAP gross margin or non-GAAP EPS? Why are we stripping out the GAAP numbers?
Right, good point. So GAAP stands for Generally Accepted Accounting Principles.
The standard rule book.
It's the standardized rule book every public company has to follow. But sometimes GAAP rules force companies to include expenses that don't really reflect the day-to-day operations of the business.
Like what?
Like one-time acquisition costs or the non-cash expense of stock-based compensation given to employees.
Oh, I see.
So non-GAAP numbers strip those items out to give investors a clearer view of the actual recurring cash-generating power of the core business. It's basically management's way of saying, hey, if you ignore the accounting technicalities and just look at the machine we built, here is how efficiently it runs.
And it runs incredibly efficiently because it doesn't stop at the gross margin line. I'm looking here. Their non-GAAP operating margins hit 35%.
Now, this is the metric that really matters for the bottom line. The gross margin tells you how profitable the product itself is, right?
Right.
But the operating margin tells you how efficiently the company is running the entire business. Hitting 35% means that after paying for the product, and after paying for all their operating expenses,
the sales force, the marketing, everything.
Everything. The entire global sales force, the marketing campaigns, the research and development engineers, the corporate overhead, the electricity bills, they're still keeping 35 cents on every dollar as pure operating profit.
That is incredible operating leverage.
Exactly. Operating leverage is what you want to see when a company's experiencing a surge in demand. It means that as revenue grows, expenses aren't growing at the same rate.
They aren't just buying that 19% growth by wildly overspending on ads,
right,
or tripling their sales headcount. They're capturing the new revenue efficiently, which means a disproportionate amount of that top-line growth flows directly down to the bottom line, and that's what drove that 14% growth in earnings per share. Okay, so I have to push back a little bit here, or at least I want to ask the skeptical question on behalf of the listener.
Go for it.
19% product growth sounds fantastic. 8 quarters of double-digit product growth sounds like an absolute dream for a legacy tech company.
It really does.
But I look at F5, a company known as like a legacy load balancer from the dot-com era, and I have to wonder, is this a structural reality or are they just getting lucky?
The luck question.
Right. Is this just a temporary blip because a few massive Fortune 500 customers placed their hardware upgrade orders at the exact same time? How does a 30-year-old tech company suddenly string together 2 straight years of this kind of product growth?
If you are evaluating the stock, that is the single most important question you have to answer.
Yeah.
Are we looking at a temporary cyclical bump or a permanent structural shift? And according to the earnings transcript, and specifically the commentary from CEO Francois Locoh-Donou, the answer is unequivocally the latter.
Structural shift.
Yes. The market is fundamentally shifting toward F5's legacy strengths. Management outlined that they are currently sitting at the intersection of 3 massive secular megatrends.
Okay.
And by secular, we mean long-term structural shifts in how the global technology architecture operates, not just temporary business cycles or lucky timing.
So let's break down those 3 secular megatrends. Let's pull them out of Wall Street jargon and translate them into plain language that we can actually use to evaluate the business. Tailwind number 1. hybrid multi-cloud adoption. What does that actually mean mechanically, and why does it benefit F5?
To really understand this, we have to rewind a few years. For a long time, the dominant narrative in enterprise technology was cloud first.
Oh yeah, everything was going to the cloud.
The assumption was that every single enterprise on earth was going to rush to move all their data, all their applications, and all their infrastructure into the public cloud.
Right, so everyone was going to abandon their own data centers and just rent server space from Amazon Web Services or Microsoft Azure or Google Cloud. The idea was that eventually everything would live there, and owning your own servers would be as outdated as, like, generating your own electricity.
Precisely. It sounded great on paper. But
How so?
well, companies drank the cloud Kool-Aid, migrated massive amounts of infrastructure, and then they kind of hit a wall.
What kind of wall?
They realized that putting absolutely everything in the public cloud leads to wildly unpredictable costs. It's often called cloud shock when the monthly bill arrives, and it's 10 times what you expected.
Ouch. Yeah, I've heard of that.
It also leads to incredibly complex compliance issues, especially in highly regulated industries. And most critically, it can lead to severe reliability and latency problems.
Because you don't control the hardware anymore.
Exactly. So what we're seeing now is the rise of the hybrid multi-cloud architecture.
Which means they are using multiple public clouds simultaneously, but they are also maintaining their own private on-premise data centers.
Yes, and more importantly for F5, companies are actively engaging in workload repatriation.
Repatriation, okay.
Right. They are looking at certain applications living in the public cloud, looking at the cost and the performance and saying, you know what? This just doesn't make sense anymore. So they are pulling those workloads out of the public cloud and putting them back onto their own physical on-premise hardware.
Okay, wait, I need to push back on this because we hear this term repatriation thrown around a lot. But moving to the cloud took these massive corporations a decade and billions of dollars in architectural redesign.
It was a huge lift.
Right. So are you really telling me they're just going to rip all those digital cables out, abandon the cloud, and go back to physical data centers? The cost of that reversal must be astronomical. Why on earth would a CIO authorize that?
Well, they aren't abandoning the cloud entirely. That's a misconception. What they are doing is becoming ruthless about workload optimization. And the transcript provided a perfect concrete example of this exact dynamic. Management talked about a very large energy and utilities provider.
Okay, a utility company.
Right. This company had over 1,000 mission-critical applications running their business. Following the trend, they had moved heavily into the public cloud, distributing these applications across 3 different cloud regions.
Seems smart. Redundancy.
Right. But then they started having problems with their cloud environment. The performance was inconsistent, and it was putting their critical services at risk.
And when you are a utility provider, critical services doesn't mean your e-commerce website takes too long to load. It means the local power grid might have an outage.
Exactly.
Can you imagine a city going dark because a public cloud server owned by a third party in another state went down for an hour?
You can't. The risk profile is completely unacceptable for critical infrastructure. You cannot outsource the reliability of the power grid to a public cloud provider's service level agreement.
No way.
So this utility company made the hard, expensive decision to repatriate those specific mission-critical workloads back on premises.
So they bought their own hardware.
They bought their own hardware, including F5 infrastructure, to run those applications locally. They needed to reduce their dependency on third-party platforms and restore absolute internal confidence in their own reliability.
Wow. And that actually brings us to another fascinating term the CEO used repeatedly in the transcript, digital sovereignty.
Yes, that's a huge theme.
He mentioned a major European government agency that was trying to standardize their security posture across a bunch of different cloud environments. But they deliberately chose to keep a select group of highly sensitive applications strictly on premises for privacy and compliance reasons.
Right.
They told F5 they needed a sovereign by design architecture. What does digital sovereignty actually mean in this context?
Digital sovereignty is becoming a massive, undeniable driver of infrastructure spending right now, particularly outside the United States.
Okay, why outside the U.S.?
Well, governments, financial institutions, and major corporations in Europe, the Middle East, and Asia are becoming increasingly uncomfortable with the reality of having their most critical proprietary data hosted by foreign hyperscalers.
Right, because if your nation's healthcare data or financial records are sitting on an Amazon or Google server, who actually controls that data?
That is the exact fear. They want their data localized. They want to know exactly which physical building the server is located in, which local citizens have access to it, and most importantly, which specific nation's legal jurisdiction governs it.
So the U.S. government can't just subpoena it.
Exactly. They do not want their data subject to foreign subpoenas or international trade disputes. In fact, Francois Locoh-Donou cited a recent analyst forecast during the call that was genuinely staggering.
What was it?
The forecast stated that 75% of enterprises internationally are expected to repatriate at least some workloads to local sovereign alternatives within the next 3 to 5 years.
Wow. 75%. If you are a retail investor who is just blindly buying public cloud stocks, assuming the migration away from physical hardware is a one-way, irreversible street, that statistic should be a massive wake-up call.
It completely flips the script.
The pendulum is swinging back. And the crucial takeaway for us today is that when these companies pull their data back locally, they can't just, plug a server into the wall and hope for the best.
Right. They need the ecosystem.
They have to build their own enterprise-grade infrastructure, which means they need to buy the bouncers and the traffic cops to manage it. They need F5.
Precisely. They are rebuilding the data center, which means they are repurchasing the critical networking and security layers that make a data center function.
And that leads us perfectly into the second secular tailwind driving F5's growth, the rapidly expanding threat landscape.
This was a major focus of the call.
Yeah. Over the last several years, the fundamental front lines of cyber defense have shifted. We used to worry mostly about the network layer. The old analogy was building a big, thick firewall around the perimeter of the company like a moat around a castle.
Right. Keep the bad guys outside the walls.
As long as the moat was secure, everything inside the castle was safe. But now, the attackers have figured out a way to bypass the moat entirely. The attacks have moved to the application layer.
And the transcript threw out a pretty wild statistical comparison here to illustrate this shift.
Yeah, I saw this.
Management noted that attacks on general IT assets grew more than 60% over the last 3 years. That is a solid, steady increase in general cybercrime. But in that exact same time frame, the volume of attacks specifically targeting the application layer surged by 140%.
140% is hypergrowth for cyber attacks. Yeah. Let's actually define this for the listener so we understand the mechanism of what is happening. What exactly is the application layer, and why are the bad guys suddenly so obsessed with it?
To understand the application layer, we really need to talk about APIs, application programming interfaces.
Okay.
If the network firewall is the moat around the castle, the API is the front door where guests are allowed to enter and request things from the staff. Let's use a real-world analogy. Think of a restaurant.
Okay, I like food analogies.
You, the customer, are sitting at the table. The kitchen in the back is the database where all the valuable ingredients, the data are stored.
Makes sense.
You don't go into the kitchen yourself to make your food. That would be chaotic and highly insecure. Instead, you use an API of the waiter.
Okay, so I give a very specific request to the waiter. The waiter takes it to the kitchen and brings back exactly what I asked for. The API is the messenger.
Exactly. Modern software is entirely built on APIs talking to each other. Your weather app uses an API to ask a server for the temperature. Your banking app uses an API to ask the database for your account balance.
Right.
The application layer is entirely composed of these constant millions per second API requests.
So how does an attacker exploit that?
Well, imagine a malicious customer at the restaurant. Instead of ordering a burger, they look at the waiter and say, "Bring me the master recipe book, the contents of the cash register, and the manager's home address."
And if the waiter isn't trained properly?
Exactly. If the API isn't properly secured and trained to reject unauthorized requests, they might just blindly walk into the kitchen, grab the cash register, and hand it to the attacker.
Oh, wow.
The attacker didn't have to break down the walls of the restaurant or fight the security guard at the perimeter moat. They just manipulated the authorized messenger. That is an application layer attack.
And because that is where the valuable data is, the customer records, the credit card numbers, the proprietary source code, that is where the attackers are focusing 100% of their energy.
Absolutely.
And F5 sits squarely at this application layer. Their entire historical business model is built around delivering and securing apps and APIs. They are the highly trained security guards standing right next to the waiter, inspecting every single request before it goes into the kitchen.
And corporate customers are clearly feeling the pain of this 140% surge in attacks, they're realizing that their legacy network firewalls are practically useless against API manipulation.
Right.
The transcript actually mentioned a massive multi-brand telecommunications provider that was dealing with this exact nightmare. Over the years, they had accumulated a completely fragmented, chaotic collection of different security tools from dozens of different vendors.
Which is a nightmare for a chief information security officer. If you have 50 different security dashboards to look at, you essentially have no security because you can't see the big picture.
Exactly, the pane of glass problem.
Yep.
So this telecom provider ended up ripping out both a SaaS-only competitor, meaning a software-as-a-service vendor that only operated in the cloud, and a cloud-native tool set. They threw it all out and consolidated everything onto F5.
Wow, a total sweep.
They moved their web application firewalls, their API protection, their bot defense, and their DDoS mitigation, which is protection against distributed denial of service attacks. They moved it all onto a single, unified F5 platform.
And they saw the exact same consolidation motion with a large multinational healthcare company, right?
Yes.
This healthcare provider had a complex hybrid cloud strategy, and they realized their incumbent security vendors were leaving massive critical gaps in their defenses. The attackers were slipping right past the perimeter, so they moved everything to F5's distributed cloud services.
And the results were immediate.
Yeah, the transcript noted that since doing that, threats that previously sneaked right past their old defenses are now being caught and blocked immediately.
For a retail investor evaluating a company, these are what we call consolidation wins, and they are massive indicators of long-term platform strength.
Because it proves the tech is better.
Right. And in a tough macroeconomic environment, companies do not want to manage and pay for 50 different niche security vendors. They want one unified enterprise-grade platform that actually works, which drastically reduces their operational overhead and their licensing costs. F5 is winning these consolidation bake-offs because their application layer security is fundamentally superior.
Okay, so we've established two massive structural pillars driving the business: the repatriation of data back to hybrid clouds and the 140% surge in application layer attacks driving vendor consolidation.
Yep.
But now we have to talk about the elephant in the room, the third secular tailwind. The one that is dominating every single financial conversation on Earth right now, the AI inference inflection.
This is where the story shifts from a solid, reliable enterprise tech company to something potentially explosive.
Yeah, because AI is accelerating everything.
It means vastly more traffic, infinitely more complex APIs, and highly distributed compute architectures. And it requires a level of network performance that most legacy systems simply cannot handle.
Right. But before we get into the software of AI, I want to stop and point out a highly specific, very counterintuitive data point from this transcript.
Oh, I know which one you're going to bring up.
A data point that completely shatters the mainstream narrative. We live in a world where everyone assumes hardware is dead, software is eating the world. Everything is supposed to be a lightweight subscription running in the cloud.
Right.
But F5 explicitly reported that their hardware systems revenue growth was over 30% for the first 3 quarters of the year and hit a staggering 32% this specific quarter.
32% growth in hardware.
Let me repeat that for the listener. A 30-year-old tech company is growing its physical hardware sales by 32% year over year. Why on earth are companies suddenly buying so many physical heavy metal boxes?
That is the ultimate aha moment of this entire earnings call. And frankly, it's the key to understanding the next decade of infrastructure investing.
So what's the secret?
The answer comes down to the unforgiving laws of physics, specifically as they apply to artificial intelligence inference. To understand this, we have to break down the crucial difference between AI training and AI inference.
Let's do it. Because Wall Street lumps it all together as just AI, but structurally, they are two completely different workloads.
Exactly. When a company like OpenAI or Google trains a massive new foundational model like GPT-4, they are engaged in AI training. They take exabytes of data, essentially the entire internet, and feed it into thousands of graphics processing units or GPUs to teach the model how to think, how to recognize patterns, and how to predict the next word.
Okay.
Training is a massive, highly centralized, incredibly energy-intensive process that takes months. It requires huge, centralized, hyperscale data centers.
Okay, so training is basically the model locked in a library for 6 months, reading every book ever written so it can learn how to speak.
Yes, that's training.
Yeah.
But AI inference is what happens when the training is done and you actually deploy the model into the real world. Inference is what happens when you, the user, open an app, ask the AI a question, and it generates an answer on the fly.
So training is learning, inference is doing.
Exactly. Training is learning, inference is doing. And inference workloads have entirely different architectural requirements than training workloads.
Radically different, right?
Radically different. Training can happen anywhere. If it takes 3 months to train a model, it doesn't matter if the data center is in the Nevada desert or Iceland.
Sure, take your time.
But inference requires real-time interaction. It requires incredible speed and extremely low latency.
Let's break down latency for a second because we throw that word around, but it is actually just physics. Latency is the time it takes for a packet of data to travel from point A to point B.
Right.
Even traveling at the speed of light through fiber optic cables, distance matters. If you ask an AI a question in New York and the server processing the answer is in a cloud data center in Oregon, it takes physical time for the request to travel across the country, hit the server, process the massive AI workload, and travel back.
And in the world of high-performance AI, waiting hundreds of milliseconds for a response is completely unacceptable.
Yeah, think about self-driving cars.
Right. If an autonomous vehicle is using AI inference to decide whether to hit the brakes, you cannot wait for the data to travel 3 states away and back. Furthermore, enterprises are now deploying AI models to process massive volumes of highly proprietary, heavily regulated corporate data.
Which ties right back into the digital sovereignty and repatriation trends we just talked about. They don't want to send their proprietary data across the internet to a public cloud inference engine.
Precisely. So to solve the latency problem and the privacy problem simultaneously, customers are deploying AI locally, on premises, or in localized edge data centers.
They're bringing the brain closer.
They're bringing the AI inference engine as close to the end user or the data source as physically possible. And to do that, they need exceptionally high-performance physical hardware to sit right in front of their local AI storage. They need hardware that can guarantee incredibly fast, highly secure, high-throughput data pipelines.
Okay, that connects the dots perfectly. The physics of data transfer simply mandate that the processing happens close to the user on physical hardware that can handle an absolute fire hose of data without choking.
You got it.
And the transcript backs this thesis up perfectly. F5 stated that their direct AI customer base grew 50% in Q3 alone. 50% in a single quarter. You do not see that kind of customer acquisition growth in legacy enterprise tech unless there is a massive structural bottleneck that only you can solve.
And management categorized this massive influx of AI demand into 3 distinct use cases. We really need to look at each one because they represent the future of F5's revenue.
Yeah, let's hear them.
The first use case is AI data delivery. They highlighted a major win with a leading autonomous systems manufacturer.
Let's break this one down. This autonomous systems company had previously used F5 to repatriate their AI training data from the public cloud back to their own on-premises data centers, right?
Yes.
They did this specifically to improve latency and gain more control over their proprietary data sets.
But here's what happened as their AI models became more sophisticated. The volume of data they needed to process and the sheer throughput demands on their network exploded so fast that their existing infrastructure began to buckle.
It couldn't handle the fire hose.
It couldn't handle it. They needed massive additional capacity, and they needed it immediately. So they bought a fleet of new, high-performance F5 hardware appliances to act as the traffic layer between their massive data storage arrays and their GPU compute systems.
So it's the bouncer and the traffic cop again. But this time, it's a traffic cop trying to direct 1 million cars a second on a 10-lane superhighway without causing a single fender bender.
Great analogy.
Because if the data gets delayed, the expensive GPUs just sit idle, waiting for the data to arrive.
Exactly. And F5's hardware can handle that extreme throughput better than almost anyone else in the market.
Which brings us to the second AI use case, AI runtime security. I think this is genuinely the most fascinating part of the transcript.
Oh, it's mind-blowing.
As companies rush to deploy their own AI applications and internal chatbots, they're suddenly realizing that these large language models are vulnerable to entirely new, exotic types of cyber attacks.
We are seeing a paradigm shift in offensive cyber capabilities. The classic example is prompt injection.
What's that?
This is where an attacker doesn't try to hack the database with code. Instead, they essentially try to Jedi mind trick the AI. They manipulate the natural language prompt, tricking the AI into ignoring its own safety guardrails, revealing sensitive training data, or executing unauthorized commands.
Oh, this perfectly aligns with the Mythos era concept the CEO is talking about. I loved that term.
Yeah, the post-Mythos era.
He said that we are entering the post-Mythos era where attackers are now actively using AI themselves to discover vulnerabilities and develop complex exploits at a speed and scale that was previously biologically impossible. AI is compressing the time between when a vulnerability is first discovered and when a weaponized exploit is launched globally.
In the old days, if a vulnerability was found, a software company might have a week or two to write a security patch, test it, and issue it to customers before the attack started at scale.
Right.
In the post-Mythos era, that window is shrunk to hours or even minutes. You basically do not have time to write and issue a software patch anymore.
Right. If the bad guys are using AI to attack your network at machine speed, you absolutely cannot rely on human speed to defend yourself. You need runtime protection.
Exactly.
You need the ability to instantly detect malicious behavior and stop attacks, while the application or the AI model is actively running and processing data.
And this leads to what is arguably my favorite statistic in the entire transcript, because it really proves the efficacy of their technology. F5 recently launched a new, fully AI-powered web application firewall, or WEF.
Okay.
And management noted that of the customers who have adopted this new AI WEF, an astonishing 75% are running it in blocking mode versus monitor mode.
Now, for any listener who isn't a seasoned cybersecurity engineer, we need to pause and explain why this distinction between monitor mode and blocking mode is so incredibly important, and why 75% is a jaw-dropping number.
Well, in the world of enterprise cybersecurity, if you deploy a brand new security tool, the absolute biggest fear of any chief information security officer is a false positive.
Which means?
A false positive is when the security tool accidentally identifies a legitimate customer or a critical piece of safe data as a threat and blocks it.
Right, so if you run an e-commerce site and your new security tool accidentally blocks 10% of real customers from checking out, you are losing millions of dollars.
And you're probably getting fired.
Right.
The cure cannot be worse than the disease. So standard industry practice is that whenever you deploy a new security tool, you place it in monitor mode for the first few months.
So it just watches.
In monitor mode, the tool just watches the traffic flowing by. It logs what it sees, and it generates reports telling the security team what it would have blocked if it were allowed to. It is perfectly safe. It doesn't actually block anything, so it cannot accidentally break the application.
It's like buying a guard dog for your warehouse, but training it to only bark.
Yes.
It will alert you that someone is there, but it is explicitly trained never to actually bite anyone, just in case it's the mailman.
That is a perfect analogy. And typically, enterprise security teams will leave a new tool in monitor mode for a very long time, carefully tuning the algorithms, adjusting the policies, and making absolutely sure the false positive rate is near zero before they ever let it actually block traffic.
Makes sense.
So to have 75% of early adopters immediately switch this new AI-powered WAF out of monitor mode and directly into blocking mode is almost unheard of.
It means they completely trust the machine learning engine. They trust that F5's AI can accurately assess the complex intent and risk of an incoming request in real time at machine speed without breaking their critical applications.
It means the guard dog is off the leash, actively biting the intruders at the front door, and the warehouse owners are completely comfortable with it. It means the technology definitively works in the real world under real pressure.
The transcript actually gave a great real-world example of this. They mentioned a major US-based professional sports league that deployed this exact AI runtime security.
Oh, the sports league, yeah.
The sports league was rolling out new AI-powered applications designed to analyze highly sensitive internal data, think detailed player health and biometric information, proprietary team strategy insights, contract negotiations.
Extremely sensitive.
You absolutely cannot have that kind of data leaking. The competitive integrity of the entire league is on the line.
So they deployed F5's AI guardrails on premises to proactively test these new applications for vulnerabilities before they launched and to defend them continuously while they were running in production. They trusted F5 to secure their most sensitive intellectual property from prompt injection and API manipulation.
Which brings us to the third and final AI use case F5 is capturing. And this one has massive financial implications. AI factory load balancing. This is all about the physical economics of running an AI data center, specifically optimizing the utilization of GPUs.
This is where we talk about tokenomics.
Tokenomics.
Right. Graphics processing units, particularly the high-end chips made by NVIDIA, are incredibly expensive. We're talking tens of thousands of dollars for a single chip. And these AI factories are buying them by the tens of thousands.
Unbelievable amounts of money.
If you are a company spending hundreds of millions of dollars building an AI factory, your absolute number one financial goal is to keep those GPUs fed with data and crunching numbers 100% of the time.
Because if a GPU finishes a calculation and then has to sit idle for even a few milliseconds waiting for the next batch of data to arrive over the network, you are quite literally burning money.
Literally.
You have a multi-million-dollar asset sitting dormant because the network pipes feeding it are too clogged?
Exactly. It's like having a Formula One engine but fueling it with a garden hose. The engine is starving. The CEO mentioned the concept of tokenomics to explain how they solve this. In AI, a token is essentially a piece of a word that the AI is processing or generating. The ultimate metric of efficiency in an AI factory is reducing the per token cost and increasing the total token throughput per second.
And how does F5 actually do that? How does networking software make a graphics chip generate more words?
It comes down to perfectly orchestrating the flow of data packets. When F5's advanced traffic management software is paired with high-performance networking cards, it optimizes the routing of every single data packet hitting the server.
Okay.
It ensures that the GPU's memory buffer is constantly perfectly fed. It eliminates those microseconds of idle waiting time, and the results are staggering. F5 has demonstrated the ability to generate 30% to 50% more tokens for a given GPU infrastructure simply by optimizing the network layer.
Let's do the math on that because the return on investment is insane.
Do it.
If you just spent $50 million on a cluster of NVIDIA GPUs and you drop in a software layer from F5 that makes that exact same hardware cluster 40% more efficient, you essentially just got $20 million worth of free compute power. The F5 software pays for itself almost instantly.
And this isn't theoretical. He gave a concrete example of a major service provider in the EEA region, Europe, the Middle East, and Africa, that selected F5 to power its new sovereign AI factory.
Sovereign AI again.
Exactly. This company is purpose-building a massive localized facility to deliver GPU as a service and AI model as a service at scale to regional customers who demand data sovereignty. They deployed a whole suite of F5 tools to enable secure multi-tenancy.
Let's define multi-tenancy quickly.
Multi-tenancy simply means multiple different distinct clients securely sharing the exact same physical AI servers without their data ever accidentally mixing or leaking across the boundaries.
Okay, got it.
It's like an apartment building. Everyone shares the same physical structure and plumbing, but you can't just walk into your neighbor's apartment.
So F5 is providing the secure walls between the apartments, the token governance to track exactly how much compute each tenant is using so they can be billed accurately, and the API endpoint protection to keep the attackers out.
And this is a critical point for retail investors to understand. Right now, the massive hyperscalers, the Amazons and Microsofts, are renting GPUs to everyone. And they have so much capital, they might not care quite as much about squeezing every single ounce of token efficiency out of their networks.
They can afford a little waste.
But the market is shifting. As regional telcos, specialized cloud providers, and sovereign nations begin building their own independent AI factories, they are incredibly cost-conscious.
Right. They don't have trillions of dollars.
They are operating on tighter margins. They will absolutely care about tokenomics and network efficiency, which perfectly positions F5 as the mandatory networking layer for the next global wave of AI infrastructure buildouts.
So let's step back and look at what this all means. We have a 30-year-old company that historically just made sure e-commerce website traffic didn't crash your server on Black Friday.
Right.
And over the last 3 years, they have successfully, quietly morphed into the critical gatekeeper, the security bouncer, and the core efficiency engine for the global AI hardware build-out.
It's an incredible pivot.
And because they are seeing such aggressive, durable adoption of their high-performance hardware and their AI security suite, management is officially changing their tune on the future. Let's look at the forward guidance.
Let's look at the numbers.
If they are the bottleneck solution for global AI factories, Wall Street must be expecting massive forward revenue. Did management actually raise their guidance to reflect this reality, or are they playing it safe?
The upward revisions were solid, and they reflect real confidence. The CFO, Cooper Werner, announced they are raising their fiscal year 2026 revenue growth outlook to approximately 9% to 10%.
Nice.
That is a meaningful bump up from their previous estimate of 7% to 8%. Furthermore, they expect Q4 revenue to be in the range of $870 million to $890 million, which is just under 9% year-over-year growth at the midpoint. And crucially, they raised their full-year non-GAAP EPS guidance to a range of $17.21 to $17.33.
Now, as an investor, upward revisions across the board are exactly what you want to see. It means management is highly confident. The pipeline of signed deals and near-term prospects is strong enough that they're willing to put their professional reputations on the line by publicly raising the bar for Wall Street.
It is a strong signal of health. However, and this is a big Howard, I want to immediately jump in here with a crucial caveat, a deep nuance that you absolutely need to understand if you are evaluating this stock for your portfolio.
Okay, lay the caveat on us. Where is the hidden risk?
While management eagerly raised their top-line revenue guidance and raised their earnings per share guidance, they stubbornly, categorically refused to raise their fiscal year 2027 gross margin guidance.
Wait, what?
They explicitly kept their long-term gross margin target pegged at a very conservative 80% to 82%.
That doesn't make any sense based on what we just discussed. They just delivered 84.2% gross margins this quarter. They are selling more of these high-margin, software-heavy hardware systems to AI factories.
Right.
Why on earth would they cap their forward margin guidance at 82%? Are they just sandbagging the numbers so they can easily beat them next year? I saw in the transcript that Wall Street analysts were practically begging them to raise the long-term margin target. An analyst from Goldman Sachs directly challenged the CFO, asking if they were just being overly conservative and holding back.
And the CFO stood his ground and said, no, we're holding the line at 80% to 82%. And the reason why is a masterclass in understanding the physical supply chain of enterprise technology.
Okay, explain it to me.
It all comes down to the dynamic pricing environment for semiconductor memory components, specifically DRAM memory and solid-state storage, or SSDs.
Oh, I see. Think about what goes into these high-performance F5 hardware appliances that are sitting in front of these AI factories. They are essentially highly specialized, incredibly powerful computers.
Yeah.
And to process a fire hose of AI data at lightning speed, they need massive amounts of RAM memory and lightning-fast solid-state storage drives.
And the global markets for memory chips and SSDs are notoriously volatile, cyclical commodity markets. The prices fluctuate wildly based on global supply and demand, geopolitical tensions in Asia, and manufacturing yields.
It's like building houses, but the price of lumber swings up and down 40% every 6 months.
Precisely. The CFO explained that they had a highly favorable outcome this specific quarter. They sourced their memory components from multiple different global vendors, and they were able to expertly navigate the spot market to secure lower-cost components, which drove that gross margin up to 84.2%.
Good for them.
But they are getting very mixed signals from their supply chain partners about the future.
Right. Memory pricing might stabilize, but it could also spike massively as every AI company on Earth tries to buy up the same high-bandwidth memory chips.
Exactly. Management noted that they are actively making advanced strategic purchases of scarce components right now to get ahead of the risk and lock in prices. But they are operating in reality.
They're being cautious.
They flat out refuse to promise Wall Street that they can maintain an 84% margin when the raw, physical materials required to build their boxes could suddenly get 20% or 30% more expensive next year due to macroeconomic variables entirely outside their control.
Okay, that makes complete sense, and frankly, I respect it. Commodity pricing can wipe out a tech stock's earnings per share overnight, turning a winning trade into a massive loser if management hasn't hedged properly.
It's dangerous.
They are padding their expectations. They would rather underpromise, guide to 82%, and then overdeliver if the supply chain cooperates, rather than promise 84% and get caught in a vicious commodity price squeeze that destroys their stock price.
It shows incredibly prudent, mature management. They recognize the macroeconomic variables, they understand the cyclical nature of semiconductor pricing, and they are guiding investors with transparency rather than hubris.
So we have gone incredibly deep today. We've gone through the headline numbers and unpacked the software-like margins. We've dug deep into the structural mechanisms of hybrid cloud repatriation, application layer API security, and the physics of AI inference driving hardware growth.
We covered a lot of ground.
We've looked at the upward guidance and the hidden supply chain risks. Now we need to pull it all together, weighing the massive structural AI tailwinds against the potential supply chain margin pressures. What is the final verdict for a retail investor's portfolio?
My stance is firm on this one, based purely on the fundamentals outlined in this transcript. I am highly bullish on F5.
Bullish. Okay, give us the final thesis. Break down the why.
Because F5 is proving, quarter after quarter, that they are a highly profitable, highly resilient picks and shovels play for the AI boom.
Picks and shovels, I like that.
Right now, everyone in the retail investing world is trying to pick the ultimate AI winner. They are throwing their capital at highly volatile, pure play AI startups that is trading at astronomical speculative growth multiples. They are trying to guess which foundational model will be the best in 5 years.
Which is really hard to do.
It is inherently speculative and it is incredibly risky. F5, on the other hand, doesn't care which AI model wins.
Right. They are completely agnostic. They don't care if OpenAI or Google or Anthropic or an open source model like Llama eventually dominates the market.
They don't care at all.
Because whoever builds the AI factory and whoever runs the inference workloads is going to need a physical load balancer, an AI-powered web application firewall, and high-speed data delivery pipelines to make the factory function.
It is the classic gold rush analogy, but applied perfectly to the digital age. Don't waste your time trying to mine for the gold yourself. Sell the pickaxes, the shovels, and the secure vaults to the miners. F5 is selling the digital pickaxes, and they are the premier supplier in town.
And they're doing it while generating massive, undeniable amounts of cold, hard cash. This isn't a cash-burning startup promising profits in 2030. F5 generated $316 million in cash flow from operations this quarter alone.
Just this quarter.
And more importantly, they generated $281 million in free cash flow. That free cash flow metric is up 12% from a year ago.
Free cash flow is the ultimate metric of corporate health. It is the money left over after the company has paid all its bills and made all its required capital expenditures to maintain the business.
It's the real money.
And what they're doing with that free cash flow is the final compelling piece of the bull thesis. They aren't just sitting on a pile of cash in a bank account watching inflation eat it. They repurchased $100 million worth of F5 shares in Q3 alone at an average price of $299 per share.
Let's explain the mechanics of a share buyback for a second and why retail investors should love them.
A share buyback is when a company uses its own cash to buy its own stock on the open market and then retires those shares. It is one of the most tax-efficient ways to return value to shareholders, often preferable to a dividend.
Right, because if they issue a dividend, you get taxed on that income immediately. But with a buyback, the overall number of outstanding shares in existence goes down, which means your specific slice of the pie, the shares you hold in your portfolio, mathematically becomes a larger percentage of the company without you having to lift a finger or pay a tax bill.
Seriously.
It artificially supports the stock price by creating constant demand, and it artificially drives up the earnings per share because the total earnings are divided by a smaller number of shares.
And the CFO made a massive commitment on this call. He publicly committed to using at least 50% of their full-year free cash flow specifically for share repurchases.
Wow, half of it.
That is a massive signal of confidence to the market. When a management team looks at all their options and decides to take half of their free cash flow and buy their own stock, they're effectively telling Wall Street, we believe our stock is deeply undervalued by the market, and the absolute best return on our capital right now is to invest in ourselves.
Okay, so let's get perfectly actionable. We always want to leave you with a clear playbook based on the data. Let's start with current holders. If you are listening to this and you already have F5 in your portfolio, what does this transcript tell you to do?
If you are a current holder, the data suggests you stay put. Do not let the fact that this is a 30-year-old legacy company trick you into thinking the growth story is over.
Don't sell too early.
Right. We talked about the physical hardware revenue growth being over 30% this year. A massive underlying catalyst for this growth is an ongoing structural hardware refresh cycle.
Right. Customers are migrating from F5's older generation of hardware, the I-Series, to their brand new high-performance R-Series hardware.
And an analyst on the call astutely asked about the timeline for this refresh. He wanted to know when this wave of upgrades is going to run out of steam.
What did they say?
The CFO noted that the refresh has been very orderly so far, but the absolute key detail he dropped is that the official end of software support date for the older I-Series hardware doesn't hit until Q2 of fiscal 2027.
That is massive. That means there is still a long multi-year runway of legacy enterprise customers out there who are going to be practically forced to upgrade their hardware over the next few quarters because they cannot operate without software support and security patches.
Exactly. It's a built-in revenue pipeline. And when they do upgrade, as management noted, they aren't just doing a one-for-one replacement of old boxes. They are actively expanding their total capacity to handle the new AI workloads we discussed. So the momentum here isn't just a temporary blip. It is structural, durable, and highly predictable for the next 2 years.
Okay, and what about considering buyers? If you are listening to this deep dive, you don't currently own F5, but you are looking to allocate some capital in the tech sector.
If you want exposure to the massive, undeniable investments happening in AI infrastructure and cybersecurity, but you prefer value-oriented, cash-generating enterprise tech companies over speculative, high-flying, zero-profit growth stocks, F5 is a very strong candidate for your watch list.
It checks a lot of boxes.
You are buying into a company with 84% gross margins, an aggressive share buyback program that provides a floor for the stock price, and deep, sticky integration into the world's most critical hybrid cloud environment.
That is a brilliant way to frame it. They are a deeply defensive stock providing essential cybersecurity and load balancing that has suddenly stumbled into a massive offensive AI hardware catalyst.
Exactly. Defensive resilience with offensive upside.
To summarize this entire deep dive, F5 has successfully navigated a massive architectural transition. They are no longer just a legacy load balancer making sure a retail website doesn't crash on Black Friday.
Nope, those days are gone.
They have officially positioned themselves as a critical, indispensable AI gatekeeper. They are managing the high-speed data pipelines, they are securing the vulnerable application APIs, and they are mathematically optimizing the expensive GPUs for the next era of sovereign computing.
They are executing a complex strategic pivot with incredible financial discipline. But, before we sign off, I want to leave you with one final, slightly provocative thought to mull over as you research this sector on your own.
Oh, I like these.
It builds on everything we discussed today regarding AI inference and hardware, but it points to a macroeconomic future that the broader market might not be fully pricing in yet.
I love it when we end on a macro theory. What is the hidden catalyst?
Throughout that earnings transcript, in between the financial metrics, management repeatedly referenced sovereign AI and sovereign AI factories being built by international telecommunications companies and foreign governments.
Yeah, you mentioned that.
As geopolitical tensions continue to rise globally, whether regarding trade disputes, technological decoupling, or national security, we are seeing a rapidly fracturing technological landscape.
Right. The internet used to be global. Now it's becoming highly regionalized and heavily guarded.
And sovereign nations simply do not want to rely on American hyperscalers for their foundational artificial intelligence infrastructure. They realize that AI is the most powerful economic and military engine of the next century.
They want control.
They want to keep their foundational AI models inside their own physical borders, subject exclusively to their own domestic laws, running on their own completely sovereign physical infrastructure.
It goes back to the old saying, data is the new oil. And no country wants all their oil pumped, refined, and stored in a vault owned by a foreign corporation.
Exactly. So my question for you, the listener, to explore is this. Could this escalating global geopolitical push for localized, government-owned AI infrastructure be the ultimate hidden catalyst that drives physical on-premise hardware sales for the entire next decade?
That would be huge.
If every major nation, every regional telco, and every highly regulated industry decides they need their own walled-off AI factory, the global demand for high-performance, secure networking hardware, the exact kind of heavy metal boxes F5 builds could far exceed current Wall Street projections.
It would be a boom.
It would create a massive hardware supercycle that is entirely detached from the traditional corporate enterprise upgrade cycle.
It is a genuinely fascinating thought experiment. If the world radically deglobalizes its AI infrastructure for security reasons, the physical hardware companies win big. The bouncers are going to be incredibly busy because suddenly there isn't just one big global public cloud party. There are thousands of highly exclusive, heavily guarded VIP rooms being built all over the world in different countries.
And somebody has to stand at the door.
And somebody, somehow, has to stand there and check the IDs at every single door. Thank you for joining us for this special Talk Tickers edition of the Deep Dive. We hope we helped clear up some of those diagnostic muddy waters for you today and gave you a framework to understand the very real physics behind the AI hype cycle. Remember, don't just trust the narrative. Keep exploring the underlying numbers, keep questioning the consensus, and keep diving deep.